So real estate investors have options to avoid or defer paying taxes whenever they sell a property, and 1031 exchange is a great example of this. It's a great way for investors to invest in properties, see some appreciation on that property, sell it, move that money into a new property, and then defer paying taxes on the appreciation. However, with 1031 exchanges, there's a lot of nuances, a lot of rules. You have to get a qualified intermediary, not to mention you're on a time crunch. You have to identify that property in 45 and then close within 180 days. There's a lot of constraints, and if you mess up and you let too many people know, they may actually get the upper hand and they may know that you're on a time crunch. Now, me, myself, if there's a way that I can do things the easy way, or maybe even the lazy way, I'll take that route. And that's where a strategy comes into play. It's called the lazy 1031 exchange. So whenever you sell a rental property, you trigger a capital gain. This capital gain is not just any capital gain. It's actually a very special type of capital gain. And in the tax world, we call this a 1231 gain. Now, this 1231 gain can actually be broken down into much further and go a lot deeper into 1245 and 1250 gains, but we'll save that for another post. Just for right now, understand that selling a rental property or business property that you've held for over a year triggers a 1231 gain. Now, one of the things that's special about 1231 gains is not only are they subject to the long-term capital gains rates, but if it is generated by a passive activity, then you can actually have a passive 1231 gain. And like I've said many times on this channel, by default, your rental activity will be considered a passive activity. You have to meet either real estate professional status, or you have to have like a short-term rental in which you materially participate in order for it to be considered non-passive, okay? So by default, you have a passive activity in real estate, and if you sell one of your rentals that you've had for over a year, then you trigger a passive 1231 gain. Now, if you remember from some of my previous posts, you can offset passive gains with passive losses. So let's bring this back around to the lazy 1031 exchange strategy. You sell a property, you trigger a passive 1231 gain. You take those proceeds, you roll it over into a new rental property. You can do a cost segregation to really accelerate the losses on that property. So this in theory now generates a passive loss, and you can use that passive loss to offset your passive gain. And maybe let's say you have a large portfolio of properties and you have accumulated some suspended passive losses over the years. You can use those suspended passive losses to offset that gain as well. So as you can see, if you can go this route, this avoids not only the time crunch of identifying a property in 45 days and then closing in 180 days, but it also takes out the need of a qualified intermediary, because in a 1031 exchange, you cannot actually receive the proceeds from the sale of the property. It has to go to that qualified intermediary, and then you also have to pay them a fee for the work that they're doing. So the lazy 1031 exchange takes out the need for some of these other factors and can actually save you thousands of dollars.